Should you or should you not put a lump sum deposit into your infinite banking policy? And you're number one. Stick around. That's what we're talking about today.
Enjoy the episode.
If you're an investor or want to be an investor and you're looking to create passive income that exceeds your monthly expenses, then this is the podcast for you. Here on the Infinite Wealth Podcast, we combine the philosophies of Robert Kiyosaki's Rich Dad Poor Dad along with Nelson Nash's infinite banking concept. Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen along with our co-host Anthony Faso. Today, we're going to be answering one of the big questions that we get during a policy design discussion. Should you or should you not put in a lump sum or a kickstart into your infinite banking policy? And Anthony,
Yes.
I'm going to explain to you what a kickstart is.
What is a Kickstart, Cameron?
Yes, guys. When you're designing an infinite banking policy, we're trying to maximize cash value. And so a very traditional design is somebody just to make consistent monthly or annual contributions into a policy. And that's kind of a traditional design. In year one, insurance companies actually give us an exception where we can actually put a little bit extra into the policy. And so that's what we refer to as a kickstart and or a lump sum. So when you guys hear us refer to that this year, just know that it's a kind of a one-time event that's going to happen in that first year. And it is an infusion of cash that shows up as cash value in the policy.
Well done, Cam.
Yeah, you're welcome.
Oh, thank you.
Yeah, guys, today what we have done in preparation for this is Anthony and I have prepared independently and looked at the pros and cons of doing a kickstart on a policy. And so, Anthony, you've been talking to me and telling me how great your points are this week. I'm going to throw it to you, man. I'll let you start us off here. Wherever you want to go. I want to start pros, cons, whatever you want to do.
I think I did tell you that, like, whatever your pros and cons are, they're already on my list. And if they're not on my list, they didn't make the cut. Is kind of what I said. But I tell you, I'm looking. I enjoy our little banter, of kind of who has better pros, than the other guy. And also, we just spent a lot of time going through becoming your own banker. So now this is a part that I like, where we kind of get to share like our own opinions on some things specifically about infinite banking. And this kickstart, there's some great reasons to do it, and then there's some reasons not to do it. So, Cameron, you're going to put it on my plate. And don't look at my notes.
I'm not looking. I don't need to.
I always like to start with the cons. I like to start kind of with the negative before we go into the positive. And one downside of having a kickstart is that it requires a term rider, which is an expense. And without getting into too much detail, because if we want to put in this extra large deposit, we need to raise a MEC line. And a great way to do that when we do a kickstart is to raise a death benefit using the term rider. Term is an expense, right? We're not building equity or a cash value in a term. Term is just supplying the death benefit. So that is one thing that needs to be considered, is that we're adding an expense onto the policy. And depending on, again, term is designed for death benefit. So depending on your health rating and your age, that cost of the term could be counterproductive. That was one of the many cons I have. Do you want to? Oh, what do you know? It's
that's
your
an obvious
first one.
That's an obvious one.
Yeah.
I too had the cost of term insurance that was on there. That's low hanging fruit when you're looking at the cons. I will say this is that cost of insurance as you age does increase, obviously. So when you're adding that on there for an older individual, it does have a higher impact. If we're young, it doesn't have too much of an impact on there because we do get those, that cost of insurance is just less. So great point there, Anthony, cost of term insurance. I'll go. Yeah. I'm going to throw one on there, is that along the same lines, that cost of term rider is really what's driving a lot of the negatives when you look at the design of this. And
Mhm.
so, along with having that term rider on there, is that when you take that term rider off, typically it's a period specific rider, 10, 15, 20-year term rider, is your death benefit is going to reduce in the year in which that term rider is taken off. And so, a lot of times when you're looking at policies, that 10th year to 11th, you do see what can be a substantial drop in death benefit at that age. And so, if you're going through and you're comparing different designs and illustrations, that's one thing that should be pointed out to you is that you make sure that the client needs to know that there's going to be a decrease of death benefit when that term rider drops off. So, along those same thread, watch out for that death benefit.
Well done, Cameron, because that was also on my list.
Mm-hmm.
and
Figured.
and I know if you're listening there, driving your car, whatever you're doing, a lot of you like many people are saying, "Well, I'm not doing this for the death benefit. I don't really care about the death benefit." How many times do you hear that, Cameron?
A lot.
Right? They don't care about the death benefit until they don't have death benefit, right? Or something happens. I, I'll tell you, I have two buddies of mine from college that are panicking because one of their term policies is expiring, and he waited until kind of towards the end, and we started underwriting, and you know what, he has a surgery that he needs to
Mm,
complete,
mm,
and the under insurance company is not going to write somebody a policy when they have a scheduled surgery coming up. It's just too much risk. So he doesn't have that death benefit. So now he is panicking. Uh, but the point is, we will care about the death benefit. I do think what I've seen that as we get older, that the death benefit and really our legacy becomes more important. So that is one downside of doing a kickstart. With that, term rider will eventually fall off, and we will have a lower death benefit.
yeah. Sorry to hear your sorority brothers going through that.
That was a good one. That was a good one.
Good.
Okay, another downside of doing a kickstart again is because of the term rider, but we need to qualify. So what that means is we're going to need more death benefit, and potentially, you do need to qualify for the death benefit, and that's typically done by a multiple of your income. When you're younger, it's about 30 times your earned income. As we get a little older, that multiple will decrease. But what can happen if we're doing a lot? In fact, I have a we're running into this problem here with the case where we have a client who wants to transfer the reserves of their business into a policy, which sounds great. We've even looked at the numbers. Numbers are great. Uh, that death benefit is on a key person, so it provides some more protection for the business. So all around, everything looks good. However, we're doing a large kickstart, and in order to do that we need a large term rider, and we're having difficulty qualifying based on the income of the company. So the downside of having this kickstart is that term rider, you may not qualify for the full amount of death benefit, which may hinder you from putting in the full amount of the kickstart you had wanted. Cam?
Well said. I too had increased underwriting amount. I know, right? Yeah, it's
They're train you well. I mean, I can't blame nobody but myself.
increased underwriting amount, and then also I put on there greater financial scrutiny. Guys,
Mm,
as we
yeah.
increase that underwriting amount, the insurance companies, for to put it, I don't know, lack of a better way, but they draws more attention, right? So if you go to them and you apply for $1 million of underwriting, that's not a big deal. But as you increase that as a factor or multiple, and you start getting up to 5 million or more, right? That's going to draw some attention from them. They're going to go in there and they're going to make sure, just like Anthony in reference, is that the capital, the cash is on hand, that we've got capital reserves, which they should.
Hmm.
And so that is what's going to happen. So at those higher limits, it does get a little bit more difficult to qualify. We got to make sure that we can substantiate those. So, Anthony, great point. Increased underwriting amount, greater financial concern or financial scrutiny. I've got one that also kind of parlays and goes along with that term rider is you have a decreased ability to pay your PUAs when that term rider drops. So at the end of that term rider, right, that rider is going to drop. It's served its purpose of kind of
Mhm.
kicking up the death benefit. And oftentimes, but not always, is you'll see that the client is going to be limited in being able to pay their PUAs. So again, that term rider drops off in your 10, you see a big drop in death benefit. Depending on how they fund the PUAs over that time frame, can lead to them putting in just only the base premium at that point moving forward. So again, that's something that you want to keep an eye out for. And what you should do is have your advisor run maybe a couple different funding scenarios and look to see what happens in year 11 and beyond with a couple of those different funding situations to make sure you have a good idea of what it looks like as far as funding from year 10 and beyond. So, uh, yeah.
Now, Cameron, that one did not make Anthony's cut.
Mm.
Okay,
Mm.
but there is some value in that. And you brought up a good point, because a lot of times we're so
Wait,
focused.
what was that?
Kind of, it didn't
What was
make the
that?
cut, but
Oh.
there was kind of a good. Oh, well, maybe I'm trying to salvage the point
Okay.
really
All right.
by
Thank
putting my own kind of
you.
spice on it. Uh, but no, I do appreciate the point that you'd mentioned that may hinder from you from continuing the same funding. And what happens when we look at the illustration, particularly when it's the first policy, I would say we have a little scarcity mindset because we're not sure how this is all going to work out, and there's always some concern about, um, am I really going to be able to want to fund these premiums, past year 10 and 20? I would say nobody knows,
Yeah.
but we want to keep that option open. And some ways we can do that, if we do a term rider, then maybe we extend that term rider for a longer period of time. Now, again, that's going to be a greater cost. The point I'm trying to make is oftentimes clients who are looking solely at the illustration and the efficiency of the illustration. And really, if we shorten the amount of time you put in the PUAs, looking at it independently, just that policy, it does make it look more efficient. However, but because then if you compare that to putting a longer term rider and putting longer PUAs on there, it's not going to be as efficient as the original design. But what we also have to realize, what if we wait, if we can't fund those PUAs in year 11, we need to start another policy. And now we're starting over from scratch and we have another slow start. So we can't just really focus on the illustration, but really have an abundant mindset of where we think or expect our funding needs to be able to go. Because honestly, with inflation and just advancing in your career, you should be able to increase funding in 10 to 20 years from now.
Well said. Awesome. Thanks for wrapping up my point.
Mm-hmm.
Anthony, do you have something you'd like to
Yes.
share here? Great.
One downside of having this kickstart, again with the term rider, is that it may limit the ability for your next policy. As I alluded to earlier, we could start we're using that death benefit on that term rider is using your insurability, uh, and that may hinder from you starting another policy on yourself. And I have like an example with a client was a little cautious of trying infinite banking out. So we had more of a modest um, a monthly deposit,
Mm-hmm.
and I say modest to him because to some people that may be aggressive. Everything is relative, but according to where his financials were, he really could have done a smaller one, right? But he did a large kickstart, uh, which required a large term rider. And then as he felt more comfortable with infinite banking, it's like, oh, Anthony, I can do more. I'd like to get another policy. We weren't able to get the size of policy on him that we wanted. because we had used up all that insurability on on that term rider. Again, we have options. We could pivot to a family member, which is what we did. But again, like you're talking about that death benefit going down. I mean, 10 years from now, his death benefit is going to be smaller. Cameron?
Well, good point. Good point. Actually, was just reviewing my notes. Um, I didn't. Actually zoned out. I don't know exactly what you said there to finish it up. I was looking for my next point. Do you want me to add to what you're saying, or do you want me to move on?
Well, whatever
Okay.
you want.
All right. Let's do this. Is I'm going to share one of the cons that I've got, and as you were talking, that's what I was thinking through. Is that this point has come up a few times in conversations, but I think it's worth noting, especially in this context, is that when clients are looking at the policies, there's a death benefit that's attached to it. And our focus has always been predominantly cash value.
Mhm.
But in certain situations, clients will ask about some of the living benefits.
Mm.
So we've got living benefits that are attached to a policy, and that's going to be chronic illness, terminal rider benefits, right? If typically rough numbers, if you get diagnosed with a chronic illness that qualifies, is you can take that to the insurance company, and they'll give you access in the form of a loan to a percentage of the death benefit amount.
Mhm.
Same thing with the terminal illness. If you get diagnosed with a terminal illness and it's doctor's note, essentially you take that to the insurance company. They will allow you to tap into a certain amount of the death benefit for quality of life purposes. What clients need to know is that in that illustration, the death benefit that you use to qualify for that percentage is only based upon the permanent death benefit. The term rider death benefit does not qualify for those living benefit amounts. And so that would be a point that hopefully everybody should know, or at least does know now.
Well done, Cam.
Thanks. Thanks. Awesome. You got any more? What else
There
you
are
got?
no more cons. We addressed them all the important ones.
Hmm.
Or
Hmm.
do you have a couple more?
Well, of course I've got one
Okay,
more.
let me
Yeah,
see.
yeah, yeah. This one, that's what I was looking at. Is I was going through my list, but this one I would say is more of an intangible.
Mhm.
What we're talking about typically is we're talking about moving money from somebody's savings account, typically, and we're
Mhm.
putting it into a policy as a kickstart. A handful of times I've had people struggle with this. And the reason that they've struggled with this is because people now do so much banking on their phone is that they're constantly checking their balances on their phone.
Mm.
And when they see that those dollars are no longer there, there's an adjustment period of getting used to not seeing that on their phone and in their app and know that they have those dollars
Mhm.
available for them. So that again, I thought is worth mentioning. There's an intangible that comes along with this of moving dollars from somebody's checking account that they can see every single day to cash value in a life insurance policy where you've got to log in and go view your account values. So again, that's one thing that you need to be prepared for it if you're considering and if you had that cash sitting in your checking account, savings account for quite a while.
Well done, Cam.
Thanks. Thanks. Now at this point,
Now we got all the
now we're
cons.
really done.
Okay.
Yeah. Now
All
we're
right.
really done.
Do you
Yeah.
have any advantages from
I do. I
let's
do.
hear them.
Yeah. All right. So some of the pros, the biggest pro, and the reason that you have this design, number one for me, is that it alleviates the slow start.
Dude, are you looking at my notes?
No, but you can
Okay.
see, read mine right there, which is probably what you did to create your list. But the when we accelerate, we put a kickstart in a policy. We're putting cash in there. One of the biggest downsides that people have when they first get introduced to infinite banking is, man, there's a slow start, right? We've addressed some of those rumors previously on the podcast where people think you got to wait 7 years before you can access it, or you got to wait 10 years before you can access it.
Mhm.
Guys, that is not the case, right? And in fact, this acceleration and this kickstart accelerates your ability to tap into that cash value. And again, right, we did have a nicely designed policy. We get a kickstart in there. We can take a loan within the first 30 days. So greater cash values available immediately with this design.
Well done, Cam.
Great.
I phrased it as doing a kickstart and minimizes the biggest obstacle people have when starting infinite banking. So we are right in line.
Ooh,
Well done.
awesome, man. Go ahead. Share point two.
Uh, The next advantage of doing this lump sum deposit or this kickstart is that it kickstarts your growth from day one,
Mm.
right? We start that uninterrupted compound immediately. Also, it allows us to access the the capital immediately. Like Cameron had said, 30 days. Well, if you're one of my clients, we can get that in as little as 20 days.
Yeah. I don't know where you got that number, but
I will show you again the next time I'm training you with an illustration. I'll
great,
kind of
great, great.
show you where to get it.
I can't wait. I can't wait. Yeah.
What's a pro you got, Cam?
Similar, right? You said kickstart your growth. I just said kind of the long-term impact on the policy is going to be beneficial. Right. If you look at some of the metrics that we look at when we're comparing designs, I personally look at break even years. What year's a good break even, which means we put a dollar in, we have a dollar available. And so I like to see those in certain years, depending on kind of the design. And so putting a kickstart in will actually help accelerate or bring those break even years up
Mm-hmm.
sooner. And so again, I'm just reiterating kind of what you said. Um, but my point that I would assumes not on yours is the way that I phrase this was you're getting lazy dollars to work.
Mm. Tell me more.
Yeah. Again, one of the cons I talked about is people having money in their checking and savings account. Uh, that is the predominant savings vehicle or savings account for most people. They let it stack up and they have it sitting in there. Those dollars are doing nothing for them,
Mm-hmm.
right? Historically, you've earned almost nothing in a checking savings. And so it's just lazy money. It's not doing anything for you. So the advantage of getting that over into a policy as a kickstart is tremendous. One is we get it creditor protected, so nobody can come in and sue us if there's a liability there. And then two is we get those dollars working, earning for us much sooner and quicker. So we're getting lazy dollars, we're putting them to work. Typically, there's two things that way that I phrase that. If somebody comes in, one of the burdens that people have when they first get started is the decision that they have is should I pay off debt, but I also want to save for retirement. What I often see, Anthony, is people don't do anything.
Yeah.
Is they just sit there,
Mm-hmm.
they're frozen. I don't know which option I'm going to do, so I'm just going to sit on cash.
Mm-hmm.
Again, creating cash value is kind of an and asset, so we can fund that, create the savings vehicle or path for retirement, but then we can put a strategic kind of debt reduction schedule for that cash value. On the other side, on the investor side, is the way that people are typically looking at it is they're usually sitting on cash just for some sort of expenditure along the way, right? We've got maintenance, we've got
Mm-hmm.
upkeep, we got all this stuff. And so they're sitting on cash as well. And so instead of just keeping that money in a savings account doing nothing, great, we're going to go put it into a policy, create cash value, have it protected, have it growing over the year for you. And if you ever need it, we're going to come back in, tap into it using a loan. So those are kind of the two ways that IBC clients are getting their lazy dollars to work for them.
I tell you, I like that. Putting the lazy dollars to work.
Mm,
I dig it. Well
great,
done.
great. Let's go
I
fast.
phrase one similar,
Mm-hmm.
but this is a way to keep your capital safer by putting really repositioning your money from somebody else's bank into your own banking system. It will protect it from creditors and predators, including the IRS. Meaning, depending on what state you live in, but every state has some level of asset protection of your cash value. Many states, like Nevada, Florida, and Texas, they're completely 100% asset protected, but it's also going to grow at a it's going to grow tax free, and in addition there is a added death benefit to it. And to me, this is the best place to store your reserves, right? We should not be deploying all of our money. Things are going to happen, life is going to happen, and opportunities are going to happen. So we should have some money that is really like our safe savings. Like I said many times, I have 1 month of expenses in my savings account because I can get access to it like that. uh, Everything more part of my reserve fund, I'm going to store it in a policy. That way it is safer. It's earning a better rate of return. And also, it kind of similar to what you had said on the downside, but this would be an advantage. I can't see it, right? So when I log onto my bank, I don't see that reserve fund, or could be tempted to maybe use that, but but I will put it right back.
Hmm.
Having a little layer or additional obstacle to get those reserve funds can be helpful.
Well said. I would agree. I would add the point that I had next was along the lines of control.
Mm,
And I think you said that protected. I forget exactly what you said, but um, the idea of control, right, is
mhm,
when you've got money sitting in your checking and savings account, is the main reason people do that is just for accessibility.
mhm,
But again, you're losing control, right? Is you don't have control over those dollars. The banks are leveraging those, 15, 30 times, right? Fractional banking, that whole argument. When you take those dollars back and you put those into your policy, you control 100% of that situation.
mhm.
Nobody can come in, exert any sort of influence on the cash value of your policy. So you're in a much safer, much more protected environment when you've taken full control of your cash and you've created cash value with it. Anthony, you got anything?
Of course, I got a couple more, some couple nuggets.
Oh, great. Save the
An,
best for last, I
Another
hope.
advantage of doing a kickstart in your policy is that it avoids the IBC buzzkill.
Hmm.
And what I mean by that, with a lot of our clients, they get excited about infinite banking, where all the possibilities that you can use the policy, whether it's rental properties or starting a business, or it gets exciting to start implementing infinite banking. And if we're doing what more typical, like an ongoing funding, it's going to take a while before we can really build up some money in there to start using it. But when we do a kickstart, and that's the reason why we call it a kickstart, because it's kickstarting the cash value from day one, which allows you to turn around. Again, my clients can get it as little as 20 days, yours is 30, but we can turn around and deploy that money 20 days afterwards. So another advantage of using a kickstart is to avoid the IBC buzzkill.
Mm. I'm gonna all the loan requests that I get, I'm sending them over to you. Right? Is you could process these quicker, so you better be ready for these things,
Okay.
Anthony. They're coming your way. Uh,
AKA Becky and
yeah.
Hannah. But yeah, send them my way.
Awesome. That's it, man. That's everything that I had. Do you have any more that you'd like to add? Unless
I
you
do,
just
I
if
always got one more.
unless you'd like to just reiterate what I said. I
I
mean, you
always
can.
got one more.
Yeah,
And
let's see what you got.
this one I think is a different take
Okay.
that not everybody shares. But I'll tell you, I am not, under most cases, every case is a little different,
Hmm.
but I'm typically not a fan of annual funding, of somebody funding their premium annually.
Yeah.
And the reason being is whatever the dollar amount is. Let's just say, to use easy math so you can follow along, Cameron, is that the premiums we're putting in are 24 grand a year, aka 2 grand a month.
Oh, thank you.
Now, if you have 24 grand, that's great. We put in the policy, no premiums are due for another year. Again, what we have to realize, we need to be thinking of the ability to put money in as a good thing. And that we can't put another dollar in for a year should really be a negative thing. And part of my reason is, if you put in that 24 from day one, we need to have 24,000 a year from now. So what people will typically do, they're systematically save and put 2 grand a month and into some account. They can't put in the policy, so they're typically going to use it and put it in a bank account. And then when the year comes, then they can just move that and put it in the policy. Instead of doing that, what I would recommend is do that 24 grand as a kickstart. And then instead of putting 2 grand in somebody else's bank, that is your premium. And there's a few advantages to that. And Cameron, how many times have you seen this, when somebody starts setting some money aside for next year's premium, And the next year it comes back and the premiums have walked away, right? And a part they don't have that system or that structure. So by putting that money in, it gives them that structure and discipline. Also, we are having our money working sooner and having those funds asset protected.
Well said. Well said. As we go through some of this stuff, Anthony, I think it's funny. I think sometimes people in the IBC community just like to argue, right? So sometimes they're out there arguing whether Kickstart's the best thing out there. Sometimes they're arguing whether Kickstart is terrible. It all depends on where somebody is. It's client specific. Nobody should be out there singing the praises and saying everybody should be doing a Kickstart because, again, it depends on where the client is and their ability and whether it's a good design for them. So hopefully we gave you guys a good overview of some of the pros and cons of looking or considering a Kickstart. And that was our intention today.
And if you want to learn more, the best next step would be to hop on a discovery call and you either really speak with Cameron or I. If you want to do a Kickstart and want the 20 days, hopefully you land on my calendar. But if not, you'll be on Cameron's and have a 30-day. But we would just encourage you to continue your research with infinite banking. This can be a great strategy to help you improve your returns and lower your taxes. Go make it a fantastic day.
Take care.
If you like this video, I know you're like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.